We've looked at the S&P 500. We've looked at the earnings per share. Now it's time to examine the relationship between the two. Let's take S&P 500. Let's call it the numerator, the top half of the fraction. Let's call the earnings per share bottom half or denominator of the fraction. Divide the two and you get the price earnings ratio. Divide the denominator into the numerator, you get the price earnings ratio. Price, the value of the S&P 500, divided by earnings or earnings per share. Notice that for 45 years, from 1945 to about 1990, the ratio was not constant, but it fluctuated within a range. Sometimes a little above 20, sometimes a little below 10. Using an eyeball estimate, let's call it 15. So we've got a value of about 15 to the nearest 5 for the price-earnings ratio. And then all of a sudden, in the 1990s, look how it surges from around 15 up to over 30. The price-earnings ratio doubles from 15 to 30. In other words, this tells you speculation was rampant, that investors were bidding up the value of the S&P 500 far more rapidly than the earnings of the stocks represented in the S&P 500. And as the price-earnings ratio rose and rose and rose, one has to ask, well, what was underlying this behavior? Why did investors think that earnings would continue to grow indefinitely? And therefore, why were they willing to bid the prices of those stocks upward in anticipation of the rising earnings? The answer to that question, of course, is the new economy. The new economy was an economy in which efficiency or productivity rose so rapidly and was rising so rapidly and would rise so rapidly that ever higher profits were on the horizon. The reason for this, of course, was the technological revolution associated with the personal computer. The web, the internet, graphics, new ways of disseminating and sharing information. All these were to cut costs, and by cutting costs, improve earnings as far as the eye could see, and therefore justify the ever-rising price-earnings ratio or the value of those stocks. Unfortunately, as we can see, eventually the price-earnings ratio rose to a peak and then fell away. We know that the Standard & Poor's 500 crashed in the year 2000. Our next set of questions, of course, to be dealt with in the next module is, well, what happened? Why did those investors become so disappointed with those earnings, and why did the earnings eventually crash?